I have the pleasure today of working with Sean Wieland, whom I've known, I think, for close to 10 years across a few of his journeys. And don't let Sean's boyish charm fool you. Sean, don't let my boyish charm fool you either, if you can find it. Sean is a player. He is managing director, research analyst at Piper Jaffray. His work, it's hard to believe, his work and his opinions on the likes of Cerner and Athena and Greenway literally move tens of millions of dollars, maybe hundreds of millions of dollars in investment. You're not willing to admit that, are you? No, all right. Prior to that, Sean worked at Hambrick. I can't see any of this, so I'm doing this by memory, but I think I know this pretty well. He's got an MBA and a degree in electrical engineering from Virginia, Vermont, which is very close to one of those. When I first met Sean, he was not a big shot, but he and I and 5 other guys had an interest in health information technology. And since then, Sean has kind of rocketed through, and now he is really a lead analyst in the electronic health record industry, and you'll see him quoted in the Wall Street Journal. But I do get the Wall Street Journal, so we're kind of even on that score. He's interviewed on deals like CNBC, so on and so forth. So we're very privileged today to have with us Sean Wieland for Piper Jaffray.
Thanks, everyone. Ed thought it was going to be a good idea to fill you all with lunch, turn the lights down, and listen to a Wall Street guy talk about forward earnings multiples. So I'll try to keep you awake here. So my name is Sean Wieland. If you think your world is regulated, this is what I got to show every time I open my mouth in public. So there you go. So the view, Ed asked me, give the view from Wall Street. So let me just real quickly hit that, and then we're going to go on to some more interesting things. What does Wall Street want? You all know we're greedy bastards. We want growth. We don't want to have any risk, so we want to be able to see where that growth is coming from. We want a lot of profits. We want to see companies that make a lot of money, and we want to see external catalysts that's going to make this happen. And so if you think about investing in health IT, this stimulus was like it hit all of these marks square and center. And so the health IT stocks, when Obama introduced part of the stimulus, funded this to the tune of $30-some-odd billion, these stocks lit up. And so despite Ed's very kind words, my job was really easy in this time. It's just basically you could close your eyes and throw a dart and hit a stock in healthcare IT that was going to go up. Now it's a little bit tougher. I wanted to just show you, this is the only chart I'm going to show you about, kind of a Wall Street valuation, because it shows that there is a huge disparity in what investors are willing to pay for. And so you always want to be up and to the right on all of these charts, and this one is no exception. The market pays more for predictable growth, and up and to the right you see Athena Health, trading at 6 times revenues, 30 times earnings. That's a very expensive stock. And so I wanted to show you that and start here in my presentation, because many of you are looking to either build business models or build strategies within your companies, and you obviously want to build something that's going to be valuable for somebody someday. So I wanted to start here to say that as you're building these strategies and building these businesses within your current roles today, you want recurring revenue. You want, and so this is where Athena has really become the poster child of health IT, because they have a business model that as long as people in this country continue to get sick and go to their doctor, Athena is going to make money. And as you move kind of downscale, down at bottom to the left, we get less and less growth, less and less predictability. So that's all I wanted to say about that. Now, my job is really to predict the future. And so my goal here today is to try to say at least one thing that you will each disagree with. And so I want to talk about predicting the futures. I can't really see with these lights up here. My God. So in order to predict the future and to tell you what's going to happen with these stocks over the coming months and years, I really need to understand both sides of any argument. I always do this with my wife. Before I engage in any conversation, I really want to understand her side. And what's interesting in my world is I'll talk with two investors back to back, and they both work equally hard, they both are equally smart, and they have completely divergent opinions on an individual stock or an individual space. So I wanted to start with the bear case for electronic health records. Why is this a market that you do not want to invest in? This is not one that I actually subscribe to, but I wanted to start here and give you kind of the other side of the view, because we've been talking all day long about what a great growth opportunity this is. The first is the stimulus was a pig in the python, that all of these companies, these companies had the business challenge of they had to give their software away and have the federal tax dollars pay for it. Not that much of a challenge. And this lit up growth, and now growth is dissipating, and so growth goes away, valuations go down. So the growth is not sustainable. We've gone from that 20% penetration rate to, as we've heard in prior presentations, to 70% plus penetration in about 4 years. It ain't going a lot higher. We've got pricing pressure. The freemium model is undercutting the license and subscription model. So companies like Practice Fusion are out there giving their software away and paying for it through banner ads. And then we heard also today that these companies are now expanding and moving into more service-based businesses like revenue cycle management, helping doctors and hospitals get paid more money faster. And of course, we can't invest in Epic, of course. The leader in this space is a private company. And so I've taken some notes here today to try to incorporate some of the prior sessions. And I wanted to add another here, is that docs don't have a lot of money. And so the question was asked up here, and with the exception of maybe Doug and Ed, but the question was asked up here, what do you want from pharma companies? And I think that the panel was filled with EHR companies. And I started chuckling to myself because that answer is really clear. They want your money. The EHR vendors want the pharma's money. The problem with these EHR business models today is that their customers, by and large, the physician practices, don't have a lot of extra capital to spend on IT. So I am a big believer in this thesis of the EHR business and the pharma business coming together. And we've been talking about synergies all day long, and I think that that's really it. They want your money, but also what you want, what the pharma companies want, is access into inside those four walls of the exam room. And I think what EHRs offer the pharma industry is an access point into those four walls that you've never had before. So that's something to think about there. Now, the bull case, which I subscribe to, in front of this stimulus, I actually was telling people, yeah, I'm a bull on healthcare IT, but I'm going to be a bigger bull in healthcare IT once there are screens in front of every doc. Where you said, Ed, and a few other people said today that doctors live in EHRs like we all live in Outlook. Doesn't anybody in this room have teenagers? Teenagers today don't use email. My 12-year-old daughter, I got her a Gmail account, but she never uses it. It's instant messaging, it's Facebook, it's Twitter. Email it's not social, it's not instant. And so I think where we are today with electronic health records is where we were in the mid-1990s when we opened our mailbox. You remember we got the CD from AOL, and we put it in the D drive, and we all got 120 minutes a month of online access, and we thought it was the greatest thing ever. I really think that that's about where we are on EHRs. I think today's EHR is more akin to a payphone before smartphones were invented. And they are all, most of these certified electronic health records are based on 20-year-old technology. This on-premise model of selling software to physicians. Ed didn't say, I used to be a sales rep at IDX. And I remember selling a system to a small practice in Southern California. And I signed the deal, and yeah, this is your hardware, and the hardware is going to be shipped, and it'll arrive in 6 weeks. And they showed up with the hardware for this small, it was about a 20-doctor practice in Los Angeles. And the practice administrator called me, and she said, what are we going to do with this thing? The server for this thing wouldn't even fit inside the door. You know, doctors' practices have no business running on-premise software to do for electronic health record. This whole business has to move to the cloud. So on-premise software, I think, is at some point is going to be dead. It's all going to be in the cloud. You can tell I'm a bull on Athena. And so there is in front of us a massive upgrade opportunity to a new technology platform that incorporates software as a service, or the cloud, and incorporates mobile technology, social, and gamification. Think about Amazon.com. Amazon.com writes millions of lines of code every year, but none of us use Amazon.com. Think of it as a software company. We use it because, you know, we can order a book, or yesterday I ordered a bike helmet for my kid, and it's probably there already today. That's how I think we're going to be thinking about electronic health records in the coming decades. It's not software, it's a platform. And as we get more people on that platform, you know, old EE major, Metcalfe's law is that the nodes of the value of a network grows exponentially as the nodes on the network grow linearly. We've been growing these nodes on this network linearly. The value of this network as it becomes a cloud-based platform is going to be immense for doing things like care coordination across care settings, and for doing a lot of the kind of marketing that you want to do at the point of care. Everyone's been talking, big data has been thrown around a little bit, and everyone that says big data, they're always like, well, they quote it. You know, they don't want to really be throwing the buzzwords around, but big data, I think, is the solution that's looking for the right problem. Right now, the best and brightest minds in big data are working for Target, trying to figure out how to get us to click on a coupon for a garden hose. But the best and brightest minds of big data are going to be moving into healthcare, and there is a huge opportunity, a huge problem to solve. And so there's this thing called the Wanamaker problem. And does anybody know what the Wanamaker problem is? We're in the Wanamaker building today. And I'm surprised that I'm the first speaker to actually bring this up, but Wanamaker was the guy that invented the modern department store. And he said that the problem with his advertising was it only worked half the time. But the problem is he didn't know which half. So I'm completely plagiarizing this from Tim O'Reilly. Some of you have probably heard him talk about this. But I think that we have a Wanamaker problem in healthcare that what is prescribed, or the treatments that are prescribed in healthcare, only work half the time. We just don't know which half. And so I think that big data has the opportunity to solve the Wanamaker problem in healthcare. So we've got this massive data set coming out of these electronic health records, both structured and unstructured data. We've got the claim forms. It's going to be a matter of years before we can spit in a tube for $200 and get our genome mapped, and that's going to add to this data set. So as I look at everybody in this room, I think that this is an incredibly exciting place to be, because I think that it's the data that's going to really reform healthcare and fix the fix the problem that we've got. So some examples of this, of how big data is being worked into these business models right now. I mean, comparative effectiveness research, that is what's behind the scenes, behind this meaningful use. They wanted to get all the docs online so they could get the data so they can figure out actually what works and what doesn't work. That's big data. We heard from Paula from Greenway talk about prime research. And prime research at Greenway is right now basically clinical trial recruitment. That's a big data strategy of using the data in the EHRs to recruit patients for clinical trials, something that pharma companies are always challenged with. Population health management, AKA, disease management 10 years later, is another big data problem. What got me thinking about this is a good friend of mine runs one of the big data strategies for one of the large U.S. banks. I'm not going to say who it is, but it is scary what they know about us. That your bank knows what you bought at the grocery store. They know that your alcohol consumption has increased. They know who you socialize with, and all of that goes into this credit score. And we were joking around about it a little earlier in one of the panels, but really your health score is a better predictor of your ability to pay your mortgage than your credit score, actually. So I don't want to I think that we should be looking at this big data opportunity and trying to understand it and what the implications are, because I think that when you combine these EHRs as platforms that span across multiple providers and multiple care settings, and you incorporate a big data philosophy around that, it can be incredibly powerful. Ed asked me to talk a little bit about the EHR landscape today. So I think that most vendors today are challenged by an outdated technology platform. So a lot of these systems that are running, a lot of the quote unquote, the better systems are client server running Citrix, which, as you know, you probably haven't used that in your personal life in 20 years. I firmly believe that the cloud is a better delivery platform in healthcare. Single instance of the software, single instance of the database makes interoperability a moot point. What cloud companies are able to do that on-premise companies are unable to do is what I call lurk behind the glass. We were talking about workflow a lot. And I think that there's an opportunity here to completely redesign the workflow of electronic health records today. Today's electronic health records are primarily insurance documentation systems. It's a piece of software that's designed to collect as much information as possible about the encounter to justify a 99214 versus a 99213 and print out an 800-page PDF to prove it. And if you ask most physicians, they're not a useful clinical tool. So I think that there's an opportunity here to really redesign that workflow, take a lot of that work out of the hands of the physician, and serve up clinical intelligence at the point of care. The challenge is that doctors want it their way, and in a SaaS platform or a cloud platform, that just can't be. The other question I was asked to address: how are purchasing decisions being made? Today, it's literally how many clicks to the center of a CBC with diff. I mentioned earlier that I used to sell software in this business, and I remember doing presentations and having a nurse sit there with her pen, and every time I hit the keyboard would make a little hash mark, and that's how they were evaluating vendors, of how many keystrokes it took to enter an order. I think where this is going with accountable care organizations and with value-based reimbursement is, how is this platform going to get my docs and patients to make smarter choices? So again, thinking about this as not a single instance of a software installed in the back room of a physician's office, but really a platform or an ecosystem that spans across multiple settings, incorporating SaaS and gamification and big data, so that when you discharge a patient, you're not discharging them and handing them a printout of discharge instructions, but instead you're discharging them with an app on their phone that's going to keep track of did they get their meds filled? Are they taking their meds? And incorporating a small social network around that patient, so that that patient's friends and families know, you know that your mom did take their meds. Or if your mom didn't take their meds, you call your mom and you say, why didn't you? So really a lot of exciting things going on in tech that have not met healthcare yet, and I think that's coming pretty quickly. And here we have more disclosures. So you didn't think I was kidding. So I wanted to just keep it short and sweet because we were running out of time, and I think Ed and I were going to just chat a little bit. He had some questions for me, and we can open it up to the audience.
Thank you. Have a seat. Mics are on? Mics are on? Yes? Good. Excellent. Excellent. What a sterling presentation.
Well, thank you, Ed.
Sean, may I call you Sean?
You may.
Thank you. You may call me Dr. Fotsch.
Typical doc.
So, since you are a seer of all things, comments on the smartphone, its role in this, standalone smartphone apps. I mean, in the paper world, that was the big breakthrough. How is the EHR going to be impacting that?
So the smartphone, or any mobile device for that matter, I think just has to be completely integrated into the workflow of the EHR. You know, take Netflix. You know, you can watch a movie on Netflix on your Apple TV, and then decide to take it on your iPad in your bed before you go to sleep, and it picks up where you left off. You know, how does it know? It's genius. That's what has to happen, I think, with mobile, is it just needs to be, we as consumers expect it to just be integrated in with everything. So there's certain functions in the EHR that are well suited for a mobile device, like looking at your inbox and looking at, for example, looking at lab results and signing off on lab results that come back. There's no reason why a doctor needs to be sitting at their desk to do that. They can be standing in line at Starbucks and pound through their inbox. So I think that that mobile, you can't just say the EHR is on a mobile device because you can run the EHR on a mobile device. You have to have a completely redesigned user interface for a mobile device that takes some of the functionality that is done in an EHR and move it to that device specifically. And then for patients, this becomes a great tool for monitoring patients once they're outside of the physician's office, to keep track of, did they get their meds filled? Are they taking their meds? And then it, I think, further engages the patient.
Yeah. So not a buyer of standalone, but a buyer of the mobile platform as a once reworked view into the electronic health record.
Yeah.
So a follow-on on that, so comment, if you dare, on the Hippocrates acquisition by Athena.
Sure. So I've known Hippocrates for a long time. Always impressed with the brand that Hippocrates carries, both within the physician market, where they have half of the physicians in the U.S. using it, and of course the brand they have within pharma. I might be the only person on the planet that actually was intrigued by their strategy of developing an EHR, and I really think that fell short primarily on execution, that they just completely...
Hippocrates' effort to create an EHR.
Hippocrates' effort to create an EHR. They underestimated the complexity of that business. It's a really tough business. You know, it costs EHR companies somewhere between $15,000 and $20,000 of sales and marketing expense to sell to one doc. So it's an expensive, capital-intensive industry to get into. So I think that Hippocrates' effort to get into the EHR business failed primarily on execution. I really believe that the right model here is to join forces with Athena. I actually wrote in a note in 2011 that, you know, I thought that this was the, you know, peanut butter and chocolate here of them getting together. It solves problems for Athena, namely awareness, and the fact that Athena's customers, physicians, don't have a lot of extra money to spend. And so it diversifies their business model, and it gives, it opens up new ways for Hippocrates to leverage the brand.
Inside the Athena footprint.
Yeah. So, you know, what's exciting about that transaction is a 10% cross-sell rate of Athena into Hippocrates. If 10% of Hippocrates users go out and buy Athena 1, it doubles the size of Athena. So
is that a prediction? Is that a note we should be? Are we going to see this?
I've already written that in a note. I think it'll be 30. I think it's going to be huge.
Excellent. Well, we'll hold you to that one.
All right, please.
Great. Can you explain the business model of a health information exchange?
No.
Thank you. I thought maybe somebody could. ACOs, impact on electronic health records.
Yeah. So. You know, it's funny. It was, I think Doug was talking about it earlier, when and there was just a study that was out that came out last night by Texas Purchasing that said that hospitals that make more mistakes are more profitable. Is this
a kill them quick?
No, this was you make a mistake.
Or how does that work?
You make a mistake, and then they come back in, and then you try something else, and that doesn't work, and you try something else.
More profitable.
Then they do more services, and they're more profitable than the better health institutions that don't make those mistakes. So, you know, ACOs are going to completely turn that upside down. And I think that you know, the big difference between ACOs and capitation 20 years ago is that the reason why capitation never worked, among many problems, is that the providers had no clue what they were getting themselves into when they signed up for risk-based contracting. And today, I think thanks to better information technology and better data, I think provider organizations have a much better idea of what they're getting themselves into, negotiating better contracts. So in order for an ACO, I think there's two sides, go back to the two sides of the ACO. Every ACO in the country can't work because the idea of an ACO is we're going to squeeze your profits and you need to gain market share in order to be successful. So you got Sharp Healthcare and Scripps in San Diego both forming ACOs on the intent that they're both going to grow market share. That is structurally impossible. But the good thing about ACOs is it's doing something to healthcare that healthcare has never had, which is it injects competition. And I think one of the major problems with our healthcare system is it's historically been a cost-plus model. So do
you see a way in which you could have an ACO without a relatively ubiquitous electronic health record among the providers?
No, I don't. I mean, I think that for an ACO to be, yes, you could have the ACO, but I don't think it would be profitable.
Yeah, it would lose money because you could.
Okay. I think what you're going to need to do is ensure that the providers are making the right decisions first in an ACO in order for it to be successful.
So rephrasing then, you would see an ACO as yet another market driver for EHR adoption.
Absolutely.
Yeah. Speaking of adoption, or more importantly, exclusion, can you comment on the Commonwealth effort to get all the EHRs to play nicely in everyone except Epic, to play nicely in the same sandbox?
Yeah.
Thoughts on that?
And it's surrounding the Epic biosphere is the way I look at it. So I used to actually write interfaces for a living between a lot of these various products, and as the saying goes in interface development in healthcare IT, is the greatest things about standards are there's so many to choose from. What is, I think, the most interesting thing about Commonwealth, we can talk about the business of Epic versus everyone else, and that's interesting. But the other thing that's really interesting from a technical perspective is actually how I understand Commonwealth is being designed, which is taking it more from the Google approach versus a central repository approach. When you search on something for Google, you find 396,000 hits in 0.004 seconds. How does it do that across such a diverse network? But that is essentially what Commonwealth, as I understand it, is doing, is the information is going to continue to reside in these various platforms, and then the search will actually bring it together into one user interface. It's something that has to happen. I mean, I think that these vendors have all used lack of interoperability as an excuse to drive profits so they can get more people on their platform. And I think that they've finally realized that they're all better off. The total market opportunity expands if the data is no longer the asset. The data has to be a commodity, and the asset has to be the ability to deliver clinical intelligence to the point of care.
So a quick follow-on question for that, and then I see we have at least one question teed up. So give me the bear case on Epic. In their market segment, they've obviously done very well, which is the academic medical centers, the larger integrated delivery networks. Where's their exposure, or do you see that stock you can't invest in going through the roof?
I think that Epic it's a phenomenal company, and they had a great vision 5 years ago of providing one integrated product across inpatient, outpatient, clinical, and billing, and they predicted accurately that that's how the end market would go. And of course, hospitals started buying physicians, and that's how it went. So that's why Epic was so successful. Epic is written on an older technology called MUMPS. It stands for Massachusetts University Multipurpose Syntax Language. It's a language that
I knew that.
Yeah, I'm sure you did. It was written in the 1960s, and when disk space was really expensive, and the entire language is consolidated down to 7 one-letter commands. That's the language that's running the majority of our health systems in this country. And I think that the Achilles heel of Epic personally is their data structure. And not to get too geeky on this, but it's a data structure that is very good at storing and retrieving information very quickly and efficiently, but it's very bad at analyzing the relationships of information. So when you need to deliver this clinical intelligence quickly at the point of care, Epic needs to rely on a data warehouse, which is something that's set on the side that's not based on real-time data, and I think that that is inherently not as attractive a model as someone that can actually serve that up off of real-time data. So I think that the move to accountable care organizations is going to require more analytics at the point of care, and I think that database is going to be lacking. I think maybe my email box will be filled up with people that disagree, but that's my opinion.
Interesting. Yes, sir.
So a question, why have we not seen consolidation in the EHR, EMR vendor industry? I mean, one would have expected there's literally dozens, if not hundreds of vendors. And a follow-on question, when do you anticipate that might happen?
I think we have seen a lot of consolidation. Now, let me take it from a couple of different angles. I mean, there are two kinds of consolidation. One would be intra-industry consolidation of examples of Allscripts buying Eclipsys, for example, and others being third-party conglomerates, GE buying IDX or McKesson buying HBOC. So we generally see one of these big transactions happen, once every 2 or 3 years. Now there is, as I think what you're alluding to is, there seems like there's anybody that could spell EHR, got their system certified, and has a system out on the market. Why haven't those vendors been consolidated? I think that. That, as I said earlier, this business is harder than it looks. I think a lot of those businesses are simply going to go away. I am very wary of roll-ups in this industry, and because if you didn't write the product yourself from scratch, it's very hard to plug multiple systems together and support multiple instances of the software and run it as a business profitably. So I think that the primary reason why you see one company buy another company is for the customer list, and it's you're buying a lot of baggage when you buy it. So I personally would rather see the growth come from organic growth through selling efforts as opposed to M&A, and a lot of these little small EHR vendors.
If you think about If you think about the CRO industry, that has been quite successful in terms of roll-ups and buyouts and things like that. So one would anticipate with the vendors in the space, the same thing happening over the next, presumably, 5 to 10 years?
So I absolutely think there's going to be consolidation. I see the difference between the CRO business model and the EHR business model. Is the CRO business model is more of a services model. More of a labor model, and just take some specific examples. Allscripts has bought a lot of companies over the years, and my view is one of the reasons why that company is Doug still here?
Well, tell me what you're going to say, and then I'll answer the question.
I mean, the product that that Doug has been working on for his entire career and is still, that's a very good product. But my issue with Allscripts is that they have bought so many products over the past 10 years that they literally have dozens of EHRs that they sell, and they got to string them all along. They got to pull them all up to ICD-10 compliance and Meaningful Use 2 compliance, and they got to bring them all forward. And there's a reason why that company does a 40-something% gross margin, whereas a pure software company can have a much higher gross margin because they're not maintaining so many various platforms simultaneously. So it's hard when you're a software vendor and you buy another software company. what you want to try to do is move all of those users over to your platform, and the docs say, well, hey, that's not the platform I want, that's not what I want to do, and you can't rush them into doing it, and so you wind up having to maintain multiple platforms. Whereas in a CRO, you know, you rebadge the employees and you say this is how we do it, and you bring it all in. So I think that it's much harder to integrate EHR vendors than say a CRO.
I think we have time for one more question, and then we will be wrapped up.
Sean, you made the point that the stimulus was the pig in the python for the EHR industry several years ago, and you also made the point that EHRs want pharma's money. So it kind of raises the question, is there kind of a quick overview way of characterizing where EHR revenue comes from today and where you expect it to come from 3 or 5 years from now?
Sure. The EHR revenue today comes from selling software licenses, implementation services, increasingly revenue cycle management services. I think that over time that morphs into a software as a service model, or a SaaS model as it's called, where the software is deployed via the cloud and you pay a monthly or quarterly fee to use the software. This is the Athena Health model. Whether it's a percentage of your billings or a flat fee, it doesn't really matter. So I think that shift is a difficult transition to go through if you're a software company. The software license revenue is a lot like crack cocaine. You know, it just goes right to the bottom line. It's addictive, and it makes you very profitable. And the
Do you have a lot of experience?
No, none personally.
Okay.
Mainly because I think I'd love it if I did, but...
Oh, you would.
But where I lost my train of thought. So, you know, so I really like companies that have made that transition already, and you know, company like Greenway is in the process of making that transition. I think that they've got what I call the Goldilocks model, where they can install their software either on-premise or in the cloud, however you want. But increasingly, they're seeing about 30% of their new business is coming in via the cloud.
Great. Ladies and gentlemen, please help me to thank Sean Wieland for joining us here today.
Thank you.